Hello and welcome back to Politico's Finance Summit. My name is Johanna Träg. I am Politico's economics correspondent based in Frankfurt. The topic of our next discussion is sustainable finance. Europe has set itself the ambitious goal of creating a net zero economy by 2050, and we're trying to assess what role the financial sector has played in achieving this and what the challenges ahead might be. A very warm welcome. Before we start, I would like to remind everyone here in the room that the session will be followed by a 10 minutes question and answer session where you have the opportunity to ask questions to our panelists, which I would like to introduce right now. With me here are Lucy Pinson, who is the founder and executive director of Reclaim Finance. Mirella Agage-Durand, the Chief Executive of Groupama Asset Management and Vice President of the French Asset Management Industry Association. Jean Boursinon, who is the Deputy Director of Financial Stability at the Bank of France and the head of the Secretariat at the Network for Greening the Financial System. And last but not least, Patrick Ducambour, who is the chair of the EFRAG Sustainability Reporting Board. Thank you very much for joining me this afternoon. Before we start the discussion, I would like to just have a very quick yes and no round. Do you still think that we have a chance of meeting our net zero emission goal by 2050? Perhaps you want to start, Lucy.
I will say yes, and I will say also that this target will not be questioned, regardless how hard it is to achieve it.
Okay. Mirella?
Yes, it's a question of willingness and commitment, but yes.
Definitely yes. I think we have no reason not to, because we have everything that we need at end. So it's a question indeed of willingness.
Okay, and do you join the optimism, Patrick?
Well, I'm coming from Brittany, which is close to Normandy, and in Normandy people say maybe. So I hesitate between maybe yes and maybe no, because frankly it's on the verge, I believe. Quite
okay. So in your view, what then are the biggest obstacles to achieving these goals in the financial sector?
Well, first of all, I think you know, for me the key element is that at the moment we are missing data. Quite frankly, that's the point. Reliable data, and that's why we are discussing so much about greenwashing, about the risks of the strategies being not clear. I'm a standard setter, and we elaborate standards for the European Union at EFRAG. So I see a major step forward with the Corporate Sustainability Reporting Directive and the drafting of the European Sustainability Standards, ESRS. But I see also the gap, because this is going to be put in place over a number of years, like 3, 4, 5, to reach a steady state in terms of reliable information. So sorry, coming also from, apart from Brittany, coming from an auditor and consulting background, I am extremely sensitive to the quality of what people commit to on the basis of what information and how they explain their trajectories and how they are accountable about their trajectories. At the moment, I think it's not easy, quite frankly, to see exactly where we're going. Therefore, my maybe, which was not a straightforward yes or no. So a major step forward is underway in the EU. Remains to be seen what remains to be seen is the practical implementation of, in my view, a groundbreaking piece of legislation and regulation, which is creating a second pillar of standardized corporate reporting, where people will be able to judge in particular on climate, if people walk the talk. So in terms of commitment, yes, we need, yes, people say that they're committed, but do we have a clear picture of how all of this is aggregating into real outcomes. So that's why I was hesitating a little bit. So for me, first things first, you know, there is a French saying that you prefer not to put the cart in front of the horses. So for me, the horses have the data which will certainly drive the cart, and for me, reliable data, which is defined as relevant, faithful, comparable, understandable, and verifiable. Those 5 qualities of data are needed in order to do what? 1, to establish proper management and to decide in a proper way on where to go, medium term and long term. 2, to establish proper relationships with all stakeholders about value creation. And 3rd, to attract capital on the much needed financing for transitions.
Speaking about the horse, how difficult or problematic do you think is that the horses in Europe seem to be a bit faster than those in the United States?
Wow. You know, you give me 1 minute, 2 minutes, 2 hours, 2 days. It is very true that the EU is in a pioneering position in terms of trying to tackle the data issue. But I see also a global momentum. So it remains to be seen what are the ways and means to get there. I think the US probably, under the current climate, political climate will be maybe a little behind, because we see what the SEC is trying to achieve, but it's not clear yet totally. The rest of the world is, we see positive signs. We see also the ISSB working, and we work with them in order to promote, at least in the EU, interoperability between the global baseline that they are promoting on climate and our own disclosure requirements to make sure. And I also see initiatives such as the one that the Bloomberg is promoting, the net zero data platform utility. I mean, it's moving, it's moving.
So what would you say, especially from a central banking perspective, is the lack of standardized data your biggest problem as well when you're trying to adjust your monitor operations, for instance, towards supporting a greener system?
Yeah, so I think data is one issue, but not the only one, to start with. Also to agree with Patrick that it's important to get to get the horse and the car in the right order. But it's also important not to wait for the car to arrive to start the journey, because you don't know exactly when it will arrive, and you will have done quite a bit of the journey before that. So indeed, what we see, I mean, we can identify data gaps in some places, model gaps, and in some other places, policies to be discussed. But frankly, there is many things that you can already do right now. And I think for us at the NGFS, I mean, the focus is very much on what we can do. We want to keep on and be part of the progress on the data side and so on. But it's not just a question. We certainly need to not be sequential in addressing climate change.
Okay. And Mirella, do you share that? I mean, do you feel for the industry it is really the lack of data that's holding you back?
Well, I will not say this is holding us back, and I would have a little bit different look about who's the horse into this engine traction. I think it's not data, it's willingness, commitment, and capital. And data is just a question to earn trust, because you see, between the 4 of us, we are 3 to be quite confident that we have a chance to go there to 2050. And because Patrick is in the data, he sees the measure of the gap we need to go toward we need to go, and he's maybe less confident. So this data is necessary because it will give trust to how long do we need to progress, where we need to go, how do we measure? And of course, if we look around us, the population is wants to go there, but they don't trust us, financial actor, to really tell the truth about, do we invest to go there? It's necessary because we need this capital, and this capital is coming from actors who need to have trust, and also because we can adjust our strategy to go faster there. So data, definitely it's something which will help, but don't use data as an excuse to say we can't go there because we don't have the data. We know for sure there are a lot of things who can allow us to go there. Maybe we can't measure them very precisely, but go and the data will follow and we will see the progress we have done.
Lucy, what do you think? Is it a lack of political will, or is it a lack of standardized data that's holding things back at the moment?
I would say political will is definitely the most important thing, because we could have all the data we dream of. The car will still not move without the political will. And I'm very thankful for all the work done by the IFRAG, because it will provide more data that we do need for sure to move in a complete way. And I'm also very grateful because I do believe that the European approach is much more complete than some approaches that we can see at international level, also because it addresses both the risk and the impacts, and it might be the only one which will be likely to deliver on new breakthrough. However, I do believe that the lack of data today is very often used by financial institutions and economic players to postpone action. And we must be very careful about that, because the CSRD is not going to be a silver bullet. And we are going to get it wrong at the first time. We will need several years to fix it and to make it complete. And we cannot wait for these several years to take action. And it's going to be very also important to be very realistic about what data can do, considering that data does support action, but data does not lead to action. Munich Re knows about climate change, is warning about climate change since 1972, but it took them 45 years to think about restricting support to coal expansion. France is a leading country on climate and ESG reporting, with the first law making it mandatory being adopted in 2001, but we are also the leading country when it is about financing fossil fuel expansion. So we must act now, and the good news is that a lot of data is already available to allow us to take actions and to meet key milestones that might not be enough to drive the transition fully, but that are necessary to make this transition possible. For example, on oil, on coal and gas, with the NGO Urgewald provides a lot of data through the global coal exit list and the global oil and gas exit list about companies operating in the fossil fuel industry, including forward-looking data. And hundreds of financial institutions are using this list, but only around 90 have stopped financing coal expansion, and around 20 have stopped financing companies developing new oil and gas projects. Even so, the IEA has projected the halt of the development of new fossil fuel projects in its net zero scenario. So again, data is important, but political will is even more.
Beyond the political will and the availability of reliable data, what role does the lack of green financing opportunities play, Mirella, perhaps for the industry? Is that holding you back?
Well, it's for me, yeah? Well, I think it is important to have green project to finance, yeah. But we need also to take into account that more than 90% of our economy is not green today. So what can we do? Do we throw everything up and just put capital in the 10% part of the economy which is green, or we work with the global economy to make this economy transition toward net zero and our goals in all the sector we have put in place, because we are speaking today about energy, but we don't need to forget the social pillar of ESG and governance. So for me, yes, there are not enough green projects today to put there all the capital that people want to do. But we don't need to focus only on green project development. For sure, we need to add this, but mainly we need to give the possibility to companies from the 90% of the economy to go toward green, so this transition. And this is very important, and also when we are speaking about greenwashing, you do have a company which is not completely green in your fund, so it's greenwashing. But the most, if you look since very on an operational basis to this, the first company producing solar and wind energy still has 40% of his activity on other way of energy, producing energy. So you can't say, I will not give money to this company. They already have 60% of the energy in green energy. Let's help them to go to 100%. So for me, it's not the main objective. The transition is the main objective. So green project, but also projects toward green, which need to be the focus of our political commitment and also private sector commitment.
But if there's more capital willing to go into green and not enough green projects, are we currently in a situation, Patrick, where the financial sector has raced ahead of the real economy, and we are sort of at the risk of creating bubbles that are not really sustainable?
If I may, I'd like to go back 1 second on the data. I insisted on the role of data, but I don't believe it is the silver bullet. So I think it is the starting point. It's not the only factor, of course. I mean, the strategies that are developed and that are explained. Transparency is not dictating behavior, of course. So, but transparency is the starting point, because you can have then people reacting, you know, the market is observing what's happening in real time, so they know, then they judge, they put the emphasis on the best companies, and they set aside the other ones, etc. So it's, and then also public policies can be developed, because beyond private strategies, public policy requires also data. But that being said, I fully subscribe to what has been said about the willingness. Now, I heard a number of financial institutions telling me, we have capital, we don't know where to put it to meet the goal. So that's why transparency is important. And having been in a number of supervisory authorities, including ACPR or AMF, I realize that the risk when there is asymmetry of information, the risk is to have the wrong pricing mechanisms. And therefore, you know, and therefore the greenwashing, before the moment you can say, oh gosh, this is greenwashing, you believe what is being said. And therefore, you price better. I mean, the general public, etc. So everything is being done to improve that. But today, when there is a lack of data and when strategies are explained, there is a risk of mismatch. So I think it is something that we see happening. So we need to catch up as quickly as possible to fill the gap in order to have clarity on the real thing. And it is true that possibly, I subscribe to what Mirella was saying. For me, you know, the situation today is a starting point. We have a goal. So for me, what is important is the speed of transition, the quality and speed of transition towards the goal, the one that you were asking about at the very beginning. So if you're clear about that, if you are explaining, then we are going to reduce the risks about bubbles. You know, green pastures being too green and brown pastures being too brown. Because at the end of the day, we see it with the energy crisis and with the war in Ukraine. You know, the brown economy is coming back to a certain extent. The oil and gas industry is making record profits, etc. Are they investing properly for the future? That's an interesting question. But on the other hand, short term, if we are unable to travel, if we are unable to warm our houses, etc., there will be an issue. So that's a long-term travel. So the long-term travel requires milestones. It's like a GPS. You have an objective, you have a destination, and you have milestones. I should reach that milestone at that time, roughly, then I make a pause, and I have a drink, then I continue my trip. So for me, avoiding bubbles and providing clarity is one of the factors to succeed. And then you have a number of technological questions. You know, for instance, when people are telling you that there is green, I don't know, green coal because you are going to capture carbon somewhere, but we don't have yet fully the technology, you know, you have to be careful about that. Who's going to develop that? It's like e-fuel, etc. Okay, all interesting questions and possible transition methodologies and technologies, but you need to clarify because we will discover medium term that part of them was true and part of them was not very true.
Jean, as a central banker, you must be particularly worried about bubbles. Where does the Network for Greening the Financial System stand there? Are you guys doing a lot of work on that issue?
Yes, indeed. And I mean, it has been very clear to us from scratch, from the very beginning, that when we think about transition risk, we speak about transition risk. We don't speak about carbon risk. So this is also risk that, I mean, Patrick was mentioning that technological risk is very real in the transition. Maybe you've got some better options coming down the road, and a lot of your investment will lose its value. That's a risk you need to. I mean, it's a good risk somehow from the perspective of the transition, but it's a risk you need to think about. And among the risks, there's indeed the risk of green bubble, to be completely honest. I mean, we've got the risk of the brown bubble, the carbon bubble on one end. I think we're in the process of deflating it, and we need to have a nuanced discussion on that, but I see progress on this one, but I would not completely overrule either the risk of green bubble. And all in all, when I think about it, whether it's in monetary policy, prudential policy, financial stability, there's a lot of things that we do that rest on the question, on the answer that we give to the question, are the risks properly priced by the market? If we say no, it's a completely different set of policies than if we say yes. So that's indeed a critical question.
Lucy, after all, we're at the Finance Summit here. So what do you think? Has the financial sector run ahead of the real economy in terms of its screening efforts?
Yeah, today's finance shapes tomorrow's world. So it's imperative that finance is more ambitious than the real economy. And it's also the whole meaning of the net zero commitments taken by financial institutions. By making these pledges, financial institutions do commit to contribute actively to transition towards greener technologies. So if banks and insurers are to keep supporting all activities, regardless of their climate impact, just because they are part of the real economy, their pledges are not even worth the ink they are written with. So there has been some financial institutions that have been showing ambitions to drive the real economy in another direction. That has been the case for the coal sector, including with the actions taken by many French financial institutions. But today, unfortunately, we do see many and the majority of financial institutions justifying their support to fossil fuel expansion by referring to the real economy dependency on fossil fuels. We hear a lot this famous sentence from BNP saying the world is carbon, so I do finance carbon. And yes, for sure, it is completely normal and understandable to find carbon in the bank's portfolio. However, by making a climate pledge, again, they do need to show ambitions and to show how to deliver on these ambitions by allocating the capital where we need to drive the economy. Today, unfortunately, very few financial institutions have clear and ambitious targets when it comes to renewable energies, and none of them, none, is pledging to multiply by 3.2 their investment into renewable energy, as will be required to be aligned with the net zero scenario by the EIA. So by also providing new support for companies that are at the forefront of the fossil fuel expansion, such as Saudi Aramco, Total Energies, or BP, banks, including BNP Paribas, are maintaining the real economic dependency on fossil fuels. And what we need to see is financial institutions conditioning their new financial services to a commitment to halt the development of fossil fuel expansion and to the adoptions of production reduction targets for the fossil fuel sector.
We've heard, greenwashing mentioned a couple of times already. Mirella, how do you feel like the private sector, how can you sort of prove that you are legitimately investing green without being accused of being green, which nowadays almost seems to be as much as sort of an insult as not being green, as greenwashing. So how do you go about that, other than the famous data?
Well, I think, unfortunately for us in the finance sector, we are already guilty day one, because it is a guilty presumption for us starting from the beginning, and sometimes could lead to opposite of what we are expecting. I think there are several answers. First of one is transparency, we already said. Also, it's an education of methodology we are using. We need to explain what we are doing. If you are financing transition in your portfolio, you will find companies who are not green. Because if they are green, they are not anymore in transition, yes? So if you explain what does it mean having brown company going toward green in your portfolio, what are you looking for, what's their transition plan, how do we follow them, do we do the necessary job to look if they allocate capitals toward the project of transition and stopping, let's say, brown projects and invest into green projects. This is the job is asked of us by investors who want to finance this transition. So it's methodology, education about methodology, transparency and reporting. And also, I think we need to explain that finance is just one of the pieces in all this puzzle toward the green economy. Yeah? Finance cannot do everything. It's just one of the instruments in use to obtain this transition. But at the government level, we have regulation in place today, which is have a lot of needs to be more precise, but it's also, we do have one in place. We also have, and we are working toward the new label, I don't know, label, who can allow to everybody to have, let's say, a third-party auditor looking into the process you are putting into the fund to have this confidence that your capital are allocated toward this transition project. So in France, we are working at the asset management industry to to include this transition in labels and give the possibility to everybody to know that this process is in place. And I think also that it's a question of it must be a pact between investor, financial actor, and the company at the end receiving the capital. The investor gives us capital, we explain to him, and we are transparent to what methodology we use to look at this allocation of capital, what reporting we are doing, and also the company receiving capital need to make her part of the job and do the job for the capital received from the investor to go toward this transition.
There's been a lot of stress testing in recent years, and Jean, your organization found that these stress tests are at the moment mainly an exercise of raising awareness, and that they will have to be improved considerably to be useful. So I'm kind of wondering to what extent these stress tests today are sort of a greenwashing equivalent for the public sector, that they're basically just saying, you know, look, we're doing all we can, and whether you feel that there actually has been a lot of sufficient progress to make these exercises useful.
Yeah. So I'll push back strongly on that, honestly. I think it's not about raising awareness. We have passed the raising awareness step, but it's about building capacity. That's what we are doing. I mean, the exercise as they are run now is really for everyone in the sector to up their game with regard to data, models, understanding the risk, monitoring the risk, managing the risk, and so on. So it's really not a question of I need to raise awareness. It's not even a question of maybe I will have something and I will feel very reassured by the risk that I would have seen. It's really about the process of building capacity. And this is leading actually quite significant change. When you look at what has happened on the European scene on this front in the past 2 years, I mean, the progress is absolutely amazing. 2 years ago, we had something like 15% of the bank that had at most basic approach to understand this risk. Now we have 85% of the banks that have at least basic approach to go there. And yes, there is a lot to do also, but there are also very real progress. And I think we should, I mean, climate stress test is not exactly something that you should compare or think about in the same way that we thought about stress tests in the great financial crisis. It's not about feeling reassured that we have enough capital in the banking system. It's about learning what to look, where to look, and how to manage.
Okay. Speaking more generally about the role of central banks, this is obviously you know, been new in that field as well. How concerned are you that you know, there seems to be a divergence between the world's major central banks, specifically the European Central Bank and the Federal Reserve, in terms of what they perceive as their role in supporting the financial system to become greener, with the Fed clearly signaling that they don't think it's as much their responsibility. Is that a problem for your network?
I think it's important to get what Jay Powell said very precise, to look at it very precisely. He said, I'm not a climate policymaker. And that I'm not sure that any central bank in the world would say, I'm a climate policymaker. Then it's a question really of expressing yourself, and you're speaking to different audience and so on. And so I mean, that needs to be taken with some kind of, you know, make sure that you get the focal right when you look at.
But he did say it's not like my knitting.
No,
I mean,
that's true. But what I'm sure is that the best thing as central bank that we can do, honestly, is to make sure for the transition is to make sure that we are providing the rest of the economy with some certainty, some anchoring into price and financial stability. That's what we are expected to deliver, and I think that these are preconditions for a successful transition. We can do a bit more. We can do different things. We are, I mean, in some countries, typically in the NGFS, we have central banks that are also development banks that have also mandates in developing their own capital markets and so on. So that may entail doing a bit more. But I think the kind of the core function around price and financial stability, no one is questioning that, honestly. And this is not, I mean, this is core to a successful transition.
But I mean, there is a clear difference, right, between, for example, efforts by the European Central Bank in adjusting their operations, for example, and the Fed. And I'm just wondering whether you feel that, you know, do you think it's just, again, are they moving at different speeds, or is it a different understanding of their role?
I think it's different circumstances that may constrain what you're doing. Typically, when you look at monetary policy, obviously, you don't deliver monetary policy in a vacuum. You're delivering monetary policy into or you're implementing monetary policy into a financial system that has a certain, you know, shape, form, and so on. So it's not the same monetary policy that you deliver in an advanced economy and in an emerging market. It's not the same monetary policy that you deliver in an economy that is dominated by bank financing versus financial markets and so on. This is shaping a lot of, I think, a lot of what is done in the end. But I'm really not questioning the kind of the commitment of the people. I think most of the people, well, I mean, everyone in the network and most of the people that I can think of, they are genuinely trying to integrate climate change in each and every part of what they are doing and to take the right conclusion. The right conclusion may change from one to another, but it's not the initial commitments that I would question.
Mirella, do you feel that the conclusions are so different on the two sides of the Atlantic that it presents a challenge for the private sector, or can you work with that?
Well, I think it is a difference between the, let's say, on the other side of the Atlantic world, it's looking at this, and Europe. And it's very important to monitor this, because we will have problem of competitiveness. Yeah. So as of today, our understanding is that we don't have the same approach. For example, just look about the growth. In the ECB mandate, we have as a mandate to monitor inflation and financial stability, which is not exactly the same mandate given to some other countries on the other side of the ocean mandate. So it is not impossible to think that we could have differences in approach, but it's very important to take these approaches into account, because we will have, after that, a problem of competitiveness of our financial system and of the way we are defining what green means in Europe and in other parts of the world. So in this way, I think it's very hard to answer, it's not my problem. Maybe it's not a direct problem, but everybody has a role into this. And in my opinion, on ECB side, we are doing a little bit more of understanding and attention toward this than which is done on the other side. But also, we don't need to underestimate the willingness on the other side of the ocean to help all this green industry emerge. They have done a very powerful commitment, this the Inflation Act with RAI, Inflation Act, and it's very strong, it's very powerful. So we can't say just we are leaders because we were in advance on this subject and we have already done a lot of things in Europe. The speed they have on these subjects could be very important, and the capital they commit to these subjects is important. So we need always to monitor this, not to lose competitiveness.
They put the emphasis on the real economy, when in the EU sometimes we put the emphasis on sustainable finance. Mm-hmm. So, you know, that's going back to your...
Yeah, Jean?
Yeah, and if I may, because I realize maybe... I think there are differences in what central banks do, that's for sure. But I think that if what you're thinking about is a non-level playing field or that kind of fragmentation, I think the core fragmentation would come mostly from lack of coordination around climate policies, than lack of coordination around the policies that central banks are involved in.
Unfortunately, we're already out of time now, so I do have to close this discussion. Thank you very much for this panel. As I said earlier, there will be a Q&A for the audience in the room, starting now. Before, before we start, though, I would like to ask people asking questions to share their name and their affiliation, and please make sure that you're asking a question and you don't make a statement, so that our panelists have the chance to answer. Are there any questions? The lady there in the second row, do you have a microphone?
That's okay.
Are we waiting for a microphone, Akash? Oh, there it is. And please also let us know whom you're addressing your question to.
Thank you. Yes, it works. Hello, I am Linda van Goor. I'm an independent professional in the field. I was happy to hear that you all believe that we can reach net zero. The IPCC report was clear. Yes, we can achieve that, but we need radical system change in order to get there. And we do not need only green finance. We need to tackle inequality. We need to tackle poverty. We need to tackle food safety and water safety first, before we can do anything about reaching net zero. And I wonder how you are considering inequality in your finance decisions. Very concrete example, the EPBD, the Energy Performance Buildings Directive, is now on the table, is almost to be finished, will have an impact on mortgage portfolios of banks. Now, this will lead member states, they will oblige member states to get to energy efficient building stock in their countries. That's great, but those obligatory refurbishments, it matters a lot how that's financed. Now, we are all in finance, and finance is not something that speaks for itself. If it is financed with either state subsidies or with guarantees on the tail risks of mortgage portfolios, for example, that's all good. Then banks can keep doing their job as pooling risks of a big pool of exposures. If, on the other hand, risk premia for physical risk are applied on individual exposures, what you get then, we're all in finance, so it gets discounted in the value, and the value of FNG buildings will go down. That will drive lower income households towards the more risky houses, right? And that's how you actually create fragmentation or polarization by design, by the design of how you organize finance. So, and you really don't want that, because you get negative feedback loops.
I don't mean to be rude, but
yeah,
could you wrap up your question and let us know who you would like to answer it?
How do you consider the IPCC's recommendation to tackle inequality first in your finance considerations?
Who's that question addressed to?
I'm curious for how Reclaim Finance looks at that from a systems perspective, and how you choose your allocations in your funds for your allocations, and how the central banks and the supervisors, of course, include this in the risk framework. Well, we need another day for this. I realize that, so apologies, but thank you very much.
I mean, I will say that thank you for your question, important question, and social justice is definitely like the priority and why we are doing the job, at least for me, and I will not be here today, I will be in the streets right now for social justice as well, which is very connected to climate justice. And I guess in our world there are a lot of ways we can integrate this consideration. When it comes to the ECB, there is we didn't have the time, unfortunately, to speak about the different measures that central banks can implement right now to drive the transition, not only for the climate, but also to meet social goals. For example, while supporting building retrofittings, we all know that the people that are the most impacted by climate change are the people that are the most impacted by buildings that are not retrofitted are the same. And definitely in this context, we are calling central banks to adopt differentiated rates in order to support green investment, including in building retrofitting, rather than rising interest rates, because rising interest rates do penalize green investment, considering, for example, the renewable sector is much more capital intensive than fossil fuels, so it's much more impacted by this situation. More broadly, when EFRAG and the CSRD is not only looking at the risks but also the impacts, I do believe that that's also in order to tackle this social consideration.
Say something on that?
No.
Well, I think the way you are putting the question, I will try to make it richer. When we are looking to one point, energetic transition or less energetic expansion, and the impact on social life. So this is why we always say in French Association of Asset Managers that it is important to have the three pillars: E, so energy, environment; S, which is also important, social impact; and G, governance. So in a way, to be able to invest, we always have processes, ESG processes, where we evaluate the three pillars of this, and in this way you are able to take into account the three parts of this transition. But what is also important is to know that if you always need to have a balance, You can't go 100% on E, which means, for example, no use of less energetically optimized buildings, because what can you do with the people living into this building? And some of them are not able to afford to make the renovation to go toward an optimization building. So this way it's very important to have the three pillars, and sometimes we observe that regulation push toward the E pillar, which is, of course, because of the Ukraine situation, the most important thing is to solve the problem of energetic dependency, which is the main source of the inflation today. And this inflation, it's a problem for a lot of people, but mainly for the people with low incomes. But we also need to take into account the S pillar. So this is what we try to do.
Looking at the time, I think we have time for one short question and a fairly short answer as well. Is there another question in the room? Please go ahead. Can we have a mic in the front row, please?
Hello, thank you very much. Fascinating discussion. Everyone, I think, agrees with the aim, net zero by 2050. Question is, with US elections next year and what's happening in the EU, are we leading or are we going out on a limb because the real world might be very different and we can't sort it out ourselves?
Is there a question for?
The gentleman sitting next to you.
Well, being a citizen, I was in a meeting with the European Parliament this morning, so that was interesting, because we see, of course, the influence of the political life, short-termism versus medium-term and long-term. When we're talking 2050, we're talking very long-term. So, the political agenda is sometimes disconnected with long-term agenda. I suffer a little bit as a standard setter because standard setting is a long journey. It takes time, you have to consider, you have to consult, you have to analyze, etc. So we cannot really navigate, short-term modifications. Yes, I observe, like you do, what will be the outcome of the elections in the US, but also the elections in the EU and the future Commission and the future Parliament. And quite frankly, I don't have a crystal ball, so I know what I will do as a citizen. I know what I will encourage people to do. They might follow or not. We are in a democracy, but we'll see. Quite frankly, I hope that wisdom prevails and that long term, you know, I still believe, I'm an optimist and my background is political sciences, so I still believe that democracy in general is reacting, maybe slowly, maybe late, but is going in the right direction. So I hope this will be the case.
I hope that wisdom will prevail. I hope that also consistency will prevail, because if it's about thinking that maybe net zero is for I don't know when, then there's a lot of things that we need to prepare for.
Very good. Thank you very much, everybody. So I think we started this off with some optimism, but it's clear that we need all horses and all carts to power ahead if you want to achieve the goal. Thank you very much, also for the audience, for your participation. I would kindly ask you to stay seated as our next session is going to start immediately. My colleague, Bjarke Smith-Meyer, will interview Merit McGuinness, EU Commissioner for Financial Services. And that will be followed by a panel discussion on Europe's ambitions on an instant and innovative payment system. Thank you.